I recently read Just Keep Buying by Nick Maggiulli. If you had to pick a thoroughbred horse to compete in horse races, there is one measurement you could base your decision on and win a lot of horse races. When famed horse owner Jeff Setter started buying horses, he looked at a horse's pedigree, nostril size, excrement weight, fast twitch muscle fiber density, and a host of other measurements, but nothing led to a winning horse. Then he started using an ultrasound machine to measure the size of horses' hearts, and only purchased horses with abnormally large hearts. In the years that followed, his horses dominated the racetracks, and one of his horses, American Pharoah, won the Triple Crown. If there was one measurement in investing that you could use to guide your investment decisions, it would be this: most markets go up most of the time. Despite a Great Depression, a world war, the threat of nuclear war, and a great financial crisis, the stock market in the United States has gone up 160,000% after adjusting for inflation from 1922 to 2022. With such a robust and consistent increase in the stock market over time, there might be no better investment advice for a long-term investor than just keep buying. But for most people, the idea of buying into a volatile stock market is terrifying. As famed financial author Jeremy Siegel said, fear has a greater grasp on human action than does the impressive weight of historical evidence. There are two primary fears that will prevent you from continually buying into the stock market over time. Let's explore each fear, then see if you think they are valid concerns at the end of the video. Fear number one: the market has peaked and it may never recover. The most common counter-argument to just keep buying is the Japanese stock market over the last 33 years. If you invested $1,000 at the peak in 1989, it would only be worth $690 today. However, if you just kept buying and invested $1,000 a year over the last 33 years, your $33,000 invested would be worth $59,000 today. That's not a great return, but it sure beats keeping your money in cash and watching it get eaten away by inflation. But luckily, you don't need to settle for mediocre returns if you don't wed yourself to one market. Remember, it's most markets go up most of the time. Not one market will go up until the end of time. In any 30-year period, 88% of markets around the world make new highs. Therefore, if you invest in several markets, the chances of your portfolio recovering from a crash in 30 years is almost 100%. An easy way to invest in most markets is to buy a large world index like VT, the Vanguard Total Stock Index ETF, which costs 0.07% to hold each year, or $7 for every $10,000 invested, which is much cheaper than a mutual fund. The Total World Stock Index ETF is a collection of 9,551 stocks in every investable market around the world, and it automatically replaces dying companies with thriving companies, so you don't need to manage it. When you diversify in a world index like VT, you're no longer betting on one region or one economy. Instead, you're betting on human ingenuity and our ability to make businesses and products that earn money over time. But even if you invest in a large diversified basket of stocks, you will still encounter substantial volatility that has large price swings throughout the year. The average intra-year price decline in the S&P, that's the 500 largest stocks in the US, which makes up the majority of the total world stock index, was 14% over the last 50 years. But the S&P still finished positive in 40 of those 50 years. You must tolerate some volatility if you want to grow your wealth. But author Nick Maggiulli says you should not tolerate more than a 15% decline in your entire investment portfolio. History shows that if you can avoid a 15% decline by dedicating a portion of your portfolio to income-producing assets that have historically increased in value or remained level as the overall stock market declined, you would have outperformed the overall stock market over time. In nearly every recession, including the Great Financial Crisis of 2008 and the COVID crash of March 2020, stocks went down more than 30%, but long-term US Treasury bonds, which people buy through the ticker symbol TLT, went up as stocks declined. And in high inflation periods, like the 1970s and now in 2022, defensive sectors of the economy, like consumer staples, energy, and utilities, which people invest through ticker symbols like XLP, XLE, and XLU, remained elevated as the overall stock market went down. The goal is to find the right balance of income-producing assets, that are uncorrelated to the movements of the general stock market, so you can keep your drawdowns to less than 15% in any turbulent market. Fear number 2. The market is crashing. I'll wait for things to get better before I buy. When the stock market portion of your portfolio crashes below 15%, it can feel like your money's being incinerated, and it becomes especially hard to just keep buying. But if you can find the courage to keep buying stocks when stocks are getting massacred, the money you invest will enjoy supercharged returns when the stock market recovers. Because if you invest when the market is down 20% and it recovers, you don't make a 20% profit, you make a 25% profit. Likewise, if you invest in the market when the market's down 33%, like it was in March 2020, you don't make a 33% profit when it recovers, you make a 50% profit. The higher percent down a market is, the more you stand to make when the market recovers, and the longer you can wait for a recovery while still enjoying nice annual returns. After the great financial crisis in 2008, when the stock market was down 55%, you could have waited 10 years for the market to recover and yield an 8% annual return for each of those 10 years. But luckily, it only took 4 years to recover, and it rewarded the people who kept buying when things were most grim, with a 22% annual return over those 4 years. In recent years, stock market recoveries have been much faster than in the past. After the March 2020 crash, the market recovered in 6 months. In December 2018, when the market was down 16%, the market made an all-time high 4 months later. Those are violent recoveries, and violent recoveries are just one reason why you shouldn't wait to buy in the hopes of buying at the bottom of a crash. If you hold off buying, or worse, sell your stocks with the hope of buying at a better price, you are likely to miss the bottom and buy back into the market at a higher price than if you just kept buying as the market went down. Even in a prolonged bear market like the 1970s, if you missed the 10 best days during the decade, you would have a negative 20% return, compared to a 17% return you would have enjoyed by just staying invested. And if you were out of the market entirely during those horrible years and just held cash, inflation would have eroded your purchasing power by 17%. In the end, if you were to receive investment advice from someone 30 years in the future, there's a good chance that their message would say, just keep buying. Because history has shown that there's no easier, time-tested method to grow your wealth than continually buying a large, diversified, low-cost index of stocks. There's a very high probability that what's worked for the last 100 years will continue to work. So if you have a long-term horizon, just keep buying when you can, with what you can, no matter how the stock market is doing, and balance out your stocks with assets that are uncorrelated to the general stock market so that you can weather severe downturns and enjoy solid annual returns over time. That was the core message that I gathered from Just Keep Buying by Nick Maggiulli. Maggiulli does a great job using data to lay out a compelling investment thesis. I highly recommend this book. I made this video as if I was giving myself investment advice, but this video is for informational purposes only and should not be relied on for investment decisions. If you would like a one-page PDF summary of insights that I gathered from this book, just click the link below and I'd be happy to email it to you. If you're already subscribed to the free Productivity Game email newsletter, this PDF is sitting in your inbox. If you like this video, please share it. And as always, thanks for watching and have yourself a productive week.